As a clearing firm, we are not at liberty of going and, to some extent, going and trying to define a particular market. We're always driven by our customers, and our customers are telling us where to go. It seems like a very straightforward job. However, I think being in derivatives world, I think most of our business and most of our customers are not coming from strategic investors who are coming and sitting on the investments for 10 years. It doesn't come, well, there is obviously the hedging business, but the bulk majority of the volume is coming from people who are looking for market opportunities. And these are the core of the customer base, and this is the core who is bringing the volumes to the market. And those people and those traders and you, they love volatility, they love market integrity, they love liquidity, and they do not particularly sort of care, I think, their jurisdiction, as long as all those criteria are met. So, which makes our job as a clearing firm slightly more complicated, because I think you may wake up one day and somebody saying, well, I want to trade Vietnam, or I want to trade something that potentially some that that's cutting head off. So as a clearing firm, you need to be in a position to create your infrastructure and create your clearing, banking, trading technology solutions to accommodate the customer. So when the customer comes on another line and saying that it's like coming to the shop, and so the customer says, well, you're selling Motorola's, and the customer says, well, they're out of business for about 5 years, I want an iPhone. You need to be in a position to offer the iPhone. We're in the midst of interesting times, I think. I think probably Mara and Non can correct me. I think there is an old Chinese saying, it's better to be a dog in tranquil time than a human in the time of chaos. But I think our customers do like volatility, and we're definitely going through the period, I think, when the system that has been operating for 50 years is kind of slowly disappearing in front of our eyes. We getting to the point where the solutions which have been working, where we've been operating all in one currency, we're doing savings in all one currency, it's all going away. And we need to embrace it. If we look at FIA table of the most traded derivatives contracts, the products that most of our, sort of, when I'm saying our, so I think brokers in UAE and Europe and US trading, so the most traded US products coming at the end of page 1 of the table. European products are not even featured on page number 1, they come at page number 2 and number 3. A lot of skeptics would be saying that, you should be looking at the size of the contract, and the contract size of the products in Asian markets are pretty slow. But then those skeptics would probably sort of refer them to Financial Times published this year that size of the IPOs that happened in 2023, and China beats US 3-1 in terms of in terms of the size. Incidentally, UAE is coming to number 4 on that list. But what I'm trying to say is that we shouldn't be really saying that there is a change in capital markets or the change is coming. The change has already happened. The fact is, we're just very comfortably sitting in our sort of screens, looking at the markets that we used to look, and we kind of have probably either missed or haven't really noticed that market and the capital center has shifted, and there is it is essentially a shift. Perhaps one of the reasons why, as I say, well, a lot of European and EU investors haven't sort of participated, I think, in Asian market. with a perceived complexity or difficulty accessing the market. I think that's probably the reason I think why we're here. And to be honest, I think when we started the process of going through the motions of creating the infrastructure versus the market, it does look daunting and quite so maybe intimidating. But then at some point I did ask myself, if I were an investor who never traded in any other market and I would come and look at LME rules, or I look at MiFID, or I look at MiFIR or regulatory reporting, would I have the same level of fear and reluctance, I think, maybe just to go and to understand? As I say, well, we are sitting in front of the screens and I think, well, we kind of get used to particular color of the buttons, particular markets, but I think the liquidity has shifted, the depth of the market has shifted, and I think as well, we should probably sort of be asking our customers to have a look. I guess we need to be in the market. I think China is the market that one way or another, whether we want it or not, I think we will be involved sooner or later. And hopefully it's going to be sooner. And I think on this note, I'll probably be passing microphone to Simon to take us further in the presentation.
Thanks. This is the pause. Thank you, Nong, for inviting me to chat to your friends, and thank you all for coming. This is a very treacherous time to talk about what the future holds, whether for equity or commodity markets, including copper. China is so What are you trying to do? Thank you. China is so integrated into the global economy so that what happens beyond its borders must impact the country's business activity. The cross currents are multiple. On the one side, America and Europe are surviving only on borrowed money. Debt just keeps getting larger every day. Organic growth has been taken over by government spending. On the other side, there are wars over Ukraine and Israel, either which could break out beyond their borders. In fact, unless world leaders are able to encourage Israel to restrain its military activities, which both Putin and Xi are trying to do, the risk of Israel deciding to exterminate not just Hamas, but Hezbollah as well, and thus formally attacking Lebanon and Syria, are very real. Should that happen, then Russia would be drawn into protecting Syria, given the alliance between the two countries, but more of that later. In the grand picture, we could see the rebirth of the Ottoman Empire, which lasted from 1453, when they overran Constantinople, to the end of World War I. History seldom repeats itself, but it does rhyme. The dots are coming together, for Turkey to join China, Russia, Iran, and other Arab countries into one large BRICS plus group of nations. The global economy is perched on the edge of a cliff, with debt over 4 times its GDP, excluding the $650 trillion derivative market. Global bond markets have sussed out these dangers, so long-term treasury yields will continue to rise until early 2025, though with some volatility, especially in next year's second quarter. Failures within the system, including more regional banks in America, are very likely to occur. The big impact of rising interest rates lies ahead of us, not behind markets. I work closely with our technical associate, Peter Goodburn of WaveTrack International, and have done so for more than 25 years. When his technical work corresponds to our fundamental analysis, we have a very strong story, which is the case now. My story will show that over the coming decade, there'll be 4 waves of expansions and contractions. The trick is going to be how to navigate the years of bull and bear markets, both for equities, commodities, including copper. Please do ask questions as I go from slide to slide, as I'd like this to be an interactive discussion, as beyond my opening remarks, I have no prepared text. So let the story start by talking through a number of slides. This is obviously self-explanatory. Here are my 4 waves. We have contractions from now until early 2024. From then until early 2025, we have expansions, what I nickname the last hurrah. Wave 3 is the really difficult period, 2025 to 2032, excuse me, which will include rolling recessions, depressions, conflicts within countries, and wars between countries. The wave 4 is having got rid of all the stupidity that the world is facing at the moment. We go back to a long period of expansions, and global GDP and copper consumption reverts back to the averages that have existed since 1900. So here is the G7 and E7 composite PMI new orders. What we know from talking to fabricators and others is that business in Europe has probably got another 4 to 6 months before it will bottom out. And in America, as I'll show in a moment, certainly from the real manufacturing, i.e. Semi-fabricators' point of view, business continues to weaken. And in China, business is pretty flat, but I will talk more about that later. So in America, you can see that the growth rate of the Conference Board's leading economic indicators continue to fall, which is very much mirrored by what one can see in the real economy, not the headline growth rates of 4.9%, which were very illusionary. And in fact, on a year-on-year basis, the third quarter was only up by 2.9%. And I've just noticed that the Atlanta Fed has cut its fourth quarter GDP to 1.2%, effectively a recession. This shows you how Eurozone purchasing managers' indices are performing. And it mirrors exactly what we hear from manufacturing sectors, whether on copper or specialty steels. The story is the same. Order books continue to fall. In China, this is a chart that our friends produced from CKGSB, and it really shows very little growth is happening. And I think that despite what the government is doing, is laying the foundations for much better growth next year. In fact, we use nominal GDP, not the real GDP numbers. And I could tell a story of how an intern of ours actually was doing the research for a member of the PBOC's monetary committee, and in so doing had the password for the real NBS database. And there was a huge difference between the published GDP deflator and the real GDP deflator. And hence, ever since then, we have used nominal GDP. And nominal GDP this year will probably grow by between 4.2 to 4.5%. But next year, for reasons I'll explain in a moment, nominal GDP should be growing by 6 to 6.5%.
They send out virtual invitations. It's like, it starts at 6:30 in the morning, 3:30.
We've got a guy talking here.
You can't see it. The thing doesn't start until 8.
From Teams.
But yeah, they did. There was 20 people waiting, then messaging them. Well, it doesn't start till I go, get your invites. Wow, straight.
The guy online. Thank you very much. So shipping is a very important indicator of business activity. And you can see that between now and April next year, business is going to continue to weaken. The equity markets have been very complacent.
It's really sick.
You know what's happening here.
I have no idea. I think it's.
Okay, thanks. Equity markets have been very complacent. It's going to require a catalyst for the market to be shaken out of its complacency. It could arise from at least two developments. The first is the fragility of the American financial system when you look at what's happening in its undergrowth. And we could well see some failures taking place between now and the end of the year. The second potential shock will arise from a nasty event evolving either in the war with Israel or over Ukraine. I hope that what I expect to see occurring, which is that Israel, having almost annihilated Hamas, will go after Hezbollah. And if that happens, it means that they will attack Syria and Lebanon, and in so doing will bring in Russia. But I'll talk about that later. But after the big correction, which is about 30%. As I will show in a moment, the world is going to go into a real inflationary era, and everybody be looking for their inflation hedges, equities, commodities, including copper. Oh, what's happened here? That's not me, by the way.
The top screen.
Okay. Yeah.
So this inflationary leg up, that chart 2-3, what, you got any idea of what copper prices will be?
Yeah, I do. Now I'll come on to that in a moment. So, first of all, this is the period in wave 1 to about April next year. And you can see how we have copper unfolding first with a little flip to the upside, and then step by step down very sharply until we actually have until about April next year, which then leads us into wave 2. But first of all, we need to think about what's going on in the wars over Ukraine and Israel, because they are going to have a big impact upon business activity and sentiment. At the moment, investors have said, Ukraine, that's miles away, it's of no real interest and no impact on us. But that's completely wrong, because really what is at stake is that Russia has been seeing the advance of NATO towards its borders. And if Ukraine became a member of NATO, then they would be able to position hypersonic missiles, once America has perfected that technology, right on their borders. So for Russia, it's a question of survival. There are hints that Putin is willing to negotiate a ceasefire. And that actually comes from a statement that the president of Belarus made. The problem is, what are going to be his conditions? And I suspect that they won't meet the wishes of America or NATO. The real danger now is what happens over Israel, Hezbollah, and Hamas. If one reads between the lines, Netanyahu really wants to decimate Hezbollah and Hamas and the PLA and make Israel the owner of all its biblical lands, that part of which are inhabited by Palestine. Of course, this is completely unacceptable to either the Arab countries or NATO countries, who all say that there must be a two-state resolution to the Palestine issue. I listen to Israeli news very regularly, channel 124, it's very good. And if you listen to the real experts there, they're all ex-senior officers in IDF or in Mossad. And every time they speak, they say the objective is the extermination of Hamas and Hezbollah. So if you're going after Hezbollah, then you're going after Russia. Then if you're doing that, and these guys also, all comes back to one simple sentence. The real perpetrator is Iran. So it's quite possible that at some stage, and I don't think it's this year, I think it's more likely to be late 2024 or 2025, that either Israel and or America decide we've had enough, we have to go after Iran. The problem is that Iran has prepared itself for an aerial attack. And in fact, my friends in the country say to me that they are expecting an aerial attack at any moment. Now, why is this important? It's important because since 2015, China, Russia, and Iran have been conducting joint naval exercises in the Sea of Oman. We know that Iran has acquired the latest Chinese and Russian anti-ship missiles, so the coast is lined with them. Iran has also developed its own hypersonic missile technology. And I know from a friend who's actually been across the straits to see which super tankers Iran has chosen should America attack, that they will then sink. They will sink those two super tankers in the narrow channel, thus stopping 20% of the world's oil from flowing out of the region. So this is something, a danger, I think, is not for this year, but I suspect it's going to be for late 2024, 2025. So we've gone through wave one, where we've had big corrections. And now with a combination of the G7 countries being in recession, America being in recession, with very deep worries about the fragility of the US financial system, with problems arising in the bond market, that the Fed, despite what it says, will be forced to change its policies, cut interest rates, and put their feet on the money supply accelerator so that credit becomes plentiful again. So what do we then have? We then have, first of all, the dollar starts falling, and get my notes out. We would have the dollar index, which is currently 106, probably rising to 109 by March. And then by the end of 24, the index will be 90, the end of 25, 70. And dare I say it, the ultimate bottom will be 51. But that is the story of de-dollarization. Energy prices will be rising sharply, supply disruptions out of Russia and other parts of the world at a time when economic recovery comes into place. And so there is an additional demand for oil. Food prices in the period second half of 24 onwards are going to soar. I'll come on to that in a moment. Driven by grain exports from the Ukraine and Russia declining, as well as fertilizers. But the big change is weather patterns, with the 89-year global cycle reappearing either the end of next year or early end of this year or in 2024. And the last time that happened, you had the decade of the Midwest Dust Bowl. Households will obviously restock. Inflation rises, so households do what they always do and buy more than they want to eat on that week. Financials will see hedges against the falling dollar and rising inflation. And always from a copper point of view, that means that they buy physical copper and futures. I can recount a story that appeared in the last great inflation era, 1979 to 1982, when after the event, a very large American chemical company that was a client then told me that they had bought 200,000 tons of copper as their hedge. That's probably equivalent to 500,000 tons today. So also manufacturing restocks everything, not just cathode, semis, components, widgets, products. But of course, bond markets will hate all of this. And we will see yields starting to rise in the second half of next year. And if I can get my little notes. So 10-year treasuries are now yielding 4.7%. They'll probably rise to 5.4% by the end of this year, 5.7% by April next year. But then in the second and early third quarters, they will collapse because of what the Fed is doing. So you'll see something like 3%. But thereafter, with inflation taking off, the dollar falling, nobody liking the way that America is running its government, you will see by mid-2025, you'll see US 10-year treasuries yielding well over 10%. So coming back to food prices, that's actually what we're seeing. Then we get into the really difficult and dangerous period, very much like the 1920s and 1930s. So we're going to have global recession, if not depression, rolling recessions, internal strife within many countries. You're actually seeing it at the moment, particularly in America and parts of Europe. And we'll probably see wars breaking out between G7 and the BRICS countries led by China and Russia. The US dollar index, as I said, will about halve in value. The BRICS currencies will replace G7 currencies as the strong currencies. I can chat about that as we've got some informed views on what's going to happen on de-dollarization. BRICS will unveil their single new currency, which won't be directly backed by gold, only indirectly, because the currency will probably be backed by the bond markets of China and Russia and others. But by then, their own currencies will be backed by gold, but not convertible into gold. So in this nasty period, equity and commodity prices collapse. But the good news is that these 7 years of hell will be transformative. Diversities and divisions will be settled through these confrontations. The good news, but that doesn't happen until the early 2030s, is that global growth in copper consumption reverts back to the 125-year trend growth rates of around 4%. And that includes copper consumption. G7 and BRICS will learn to live with each other. The risk is that America loses its hegemonic status, but still remains a great nation. The probability is that the EU will break up. The interesting development is that by then, BRICS will control most commodities. But the big question is what currency will they be sold in? It won't be dollars. So what does this all mean in terms of GDP? Well, here is our forecasts. As you can see, the fall starts in 2025, peaks in 26. 27 is still a bum year, and then we start seeing recovery. Now, let's turn to copper, and first mine production. In the last 2 months, spot TCs have fallen from an average of 95 to a range of 82 to 85. The main reasons being new smelter startups ramped up production and thus booked additional material in China. Existing Chinese smelters are running at max. Recovery in acid prices removed an important bottleneck. Outside China, production and logistical problems have reduced the flow of concentrates from Rio Tinto's Mongolia mine very significantly. Also, the Panama government has reneged on its agreement reached with Panama Cobre, resulting in mine and logistical problems. First half of next year, the probability is that there will be an oversupply of mine production, but in the second half, a very tight conks market, with TCs probably falling into the 60s. These forecasts are produced last month by the IWCC, and in their analysis, they make an adjustment for unaccounted supply disruptions of about 300,000 tons for this year and 1,200,000 tons next year. Also, it's debatable whether the mine production data fully accounts for the fall of the copper content in concentrates, which globally has fallen from around 27% to around 24%. So on our own internal production forecast, we make an adjustment. Refined production. Here, the IWCC probably understates significantly the refined production that will come out of China. Our smelter friends there think that refined production this year will be more like 11.5 million tons, and next year 13.5 million tons. And that's going to have a very significant impact on China's import and export of cathodes. Codelco is probably not going to meet its target production either this year or next year. Now let's have a look at copper consumption. a lot of people underestimate how much copper is being lost to substitution. This was a table that the ICA produced at the IWCC meeting in Bangkok in May. Two comments I'd like to make. First, and it's very important, 40% of the wiring going into EVs is being replaced by aluminium. And that comment comes from the CEO of Sumitomo Electric Industries, the largest global maker of wire harnessing for cars. The second is that Daikin, the world's largest aircon maker, took a decision after 20 years of research to substitute copper in its copper tubing for aluminium. That is a 2 million ton global market. If Daikin, which they have, moves to aluminium, other aircon makers will be forced to for cost and competitive reasons. So that rather reminds me what happened to copper being used in the auto radiator market in the 60s and 70s when aluminium replaced copper. So here is our analysis of the global copper and copper alloy semis consumption. Now for next year, you can see we have a consumption of 25.3 million tons. But the point I'd like to make, going back to my earlier comments, is that consumption is one thing, but demand is quite another. And we are very likely to see, for the reasons I outlined, that demand will be 26 million tons, if not higher. That, of course, will have a huge impact on copper prices, as I'll discuss in a moment. For China, basically, the market is flat, largely because of a collapse in the second half of this year in scrap used for wire rod and brass mills. I've probably underestimated the 2024 figure, but again, for the reasons I've given, demand will be much higher than consumption. Now we come to what I think is a very important change in the market structure. China has been a mega importer of cathodes, running from 4.5 million tons in 2020 to 3.5 million odd tons last year. The problem is that China's smelters and refineries are increasing capacity and production to such an extent that China will become a net exporter of cathode. That's going to have a very significant impact on the arb between the LME and China. There's another comment that I should make on that issue, on this particular issue, and that is that China this year has been financing Russian cathode that it cannot export. By the end of this year, that should be somewhere around 500,000 tons. Now, in return for financing that stock, I am told that there's an agreement that when China wants to draw on those stocks in Russia, there will be a discount of $200 per ton against whatever is the agreed price. So why import cathode when you can get it at a $200 discount? Yeah, only one. Yeah, hold on. I said the demand, consumption is one thing, demand is another. You add in what financial institutions are going to do, what fabricators are going to do, what the manufacturing sector is going to do, and you're going to end up with a huge deficit. 700,000 tons, million tons, I don't know. But that's going to be the reality. And as I said earlier, go back and look at the template 1979 to 1980, and then the collapse in 1982. In 1 year, you had a 75% increase in the copper price. Now you've got much bigger players who are putting more money into them, able to put more money into the market. So it's not going to be a 75% increase. It's going to be more than that, which comes back to what we think will happen, is that you go from a low point of, say, $6,000 at the end of March, early April, to close to $14,000 in early 2025. 1 year. 1 year, 79, 1980, more or less 1 year this time around. So, questions, please.
Yes, Simon, on the US dollar going over after 25, so what does that mean for currencies like the dirham, which is the US dollar? Do you think it will be critical?
Well, on my tea leaves, I think that the dirham will break its peg to the dollar possibly quite soon. I'd say next year. Then the dirham will rise sharply, probably against all currencies. And that's great news for the government, because a stronger currency will reduce domestic inflation, particularly food prices, most of which are imported.
Hi, sir. Good evening.
Second question is, in wave 2 there, which peaks in 25, if this conflict with Iran escalates at about the same time, so you've got a peak in wave 2, oil prices are already high, and if they block the straits, and oil prices will go parabolic.
Yeah, correct. And what also happens, it blows up the derivative market.
That's the elephant in the room, because
Yeah, exactly.
$600 trillion market.
Yes. Now, I'm not saying it's going to happen, but I think it's a big risk where you look at how the dots are coming together. This rather reminds me of the reaction I got at a Jeffries conference in Hong Kong, when at the end of a similar presentation, I was met with deathly silence. And somebody asked a question, and after that, there was a flood of questions.
So what's the hedge after 25? Is it precious metals? Is that the hedge?
Physical assets,
Tangible physical.
physical assets. And particularly gold. I mean, gold is definitely coming back into the monetary system. Everything I put together suggests that both China and Russia will back their currencies with gold. In China, for instance, since the Shanghai Gold Exchange was started in 2005, I think it was, or 2006, the general public, institutions and households have bought approximately 22,000 tons of gold, and they're still buying. There was a few months ago, the government issued an arrangement by which a household can actually buy physical gold on a monthly stock order. So China will turn around one day and say, our currency is backed by gold, which is owned by the population. But the government, through different ministries, including the PLA, owns also something of the order of 25,000 tons. I know the PLA does because I have a very good friend who used to be the president and CEO of a big Japanese company. And as he said to me over lunch one day, I have to know a lot of important people in China. One of them is one of the top generals. Whether he's still there or not, I don't know. So he invited me down to headquarters for drinks that started at 4 o'clock in the afternoon. 6 o'clock, he tapped me on the shoulder. He said, let's go for a walk. So we walked across the compound to a big warehouse. And he said, my jaws dropped when I saw inside the warehouse was stacked from floor to ceiling with bars of gold. So voila. In Russia, the published number is only, I forget the actual number, is about 1,200 tons. But the company that sits above the central bank owns 10,000, 11,000, 12,000 tons. And the last I heard a couple of years ago from somebody who should know, it was a total figure of 12,000 tons. I don't know how you turn this off.
Thank you, Simon, for the very, very good presentation. The reason why I invite Simon, love Simon about that he never reads and follows the big Morgan Stanley, JP Morgan or Goldman Sachs research report. He reads his own tea leaves and tell us what his tea leaves tell him. And the only thing I will say is next time, come to Simon's presentation, bring your sunglasses, okay? It's a bit of
Double whiskey.
Okay, thank you, Simon. Now, next, we're going to invite a lady, Lisa Xiao from Arna Shanghai Futures Exchange for a short video for us because she can't make it by herself. So she produced this video for us as a brief introduction of the Chinese derivatives products and the market development in the last few years. It's going to be played from the laptop, so hopefully we can all hear. Shall I put it speaker?
Yeah.
Good afternoon, everyone. It's my pleasure to attend today's meeting. Pitifully, I cannot make it offline, but I hope that my sharing today online can give you a brief picture of what's happening on the Chinese market and the latest development in the opening up of our market. My presentation today will cover 4 aspects. First is an overview of China's futures market in the first half of this year. Second is China market access channels. Third is the opening up progress of SHFE and INE. And finally, next steps as we move forward. In the first half of this year, the cumulative trading volume and turnover of China's futures market reached 3.95 billion lots and RMB 262 trillion yuan respectively, up by almost 30% and 1.8% year-on-year respectively, a huge increase compared with the same period last year. As we can see from the left chart, in terms of the global commodity futures market, most of the trading volume was contributed by the Asia-Pacific region, and from the Asia-Pacific region, most of the trading volume comes from the China market. According to FIA statistics, the trading volume of China's commodity futures and option market accounts for almost 71% of the world's total. And for us, in the first half of this year, Shanghai Futures Exchange, including our subsidiary INE, has a cumulative trading volume of 1.05 billion lots, up by more than 20% year-on-year. And here are the product lines of all the futures exchanges in China. Currently, by the end of October this year, 122 products are listed on China's futures market, including 79 futures and 43 options. Among that, 19 are newly listed this year, which is a significant increase compared with the total number of new products listed last year, which is about 12 products. I think this is thanks to the release of the futures law, because after the release of the futures law, the product listing mechanism was transformed from the approval system to the registration system, which is beneficial to step up the listing of new products in the market. As we can see from the slide, there are 5 futures exchanges in China, including 4 commodity futures exchanges, such as Shanghai Futures Exchange, Zhengzhou Commodity Exchange, Dalian Commodity Exchange, and Guangzhou Futures Exchange, and the remaining one, CFEX, China Financial Futures Exchange, as the name suggests, is focusing on the financial derivatives. Out of all the products listed, 24 are specified domestic products, which are also known for international products. These products are directly open to overseas investors, including 15 futures and 9 options. For us, all of our international products are listed on our subsidiary, INE, which is short for Shanghai International Energy Exchange, including crude oil futures, Bonnet copper futures, low sulfur fuel oil futures, TSR20 rubber futures, and the newly listed freight index futures, as well as an option on crude oil. And apart from those international products, last year we also opened another channel for overseas investors, and 46 products altogether currently are open to qualified foreign investors, including 26 futures and 20 options. These are tagged in blue in this slide, and for SHFE, we have opened 16 products to QFIs. Regarding the specific access channels between the specified domestic products and QFI, I'll talk about that later in later slides. And here comes the first question: where are we among global exchanges? As mentioned in my first slide, actually in terms of commodity futures trading volume, Chinese exchanges rank among the top 3 globally, according to FIA statistics. As you can see, all the top 3 commodity exchanges are from China, and SHFE ranked among number 3 last year. Contract-wise, out of the top 15 contracts by volume in the first half of this year, 9 out of these contracts, industrial metal contracts, are from Shanghai Futures Exchange, such as steel rebar, hot rolled coil, aluminum, nickel, zinc futures, as well as tin, copper futures, stainless steel futures, etc. And in terms of precious metal contracts, 4 out of the 15 contracts are from Shanghai Futures Exchange, such as silver and gold futures and silver and gold options. And in terms of energy contracts, we also have 4 contracts in the listing, that is fuel oil futures and bitumen futures, which are listed on Shanghai Futures Exchange, and crude oil futures and low sulfur fuel oil futures that are listed on our subsidiary INE. And in terms of agricultural contracts, as we can see from this slide, almost all the top 11 contracts are from China. And for SHFE, we have wood pulp futures and natural rubber futures that are ranking number 10 and number 11, respectively, by the trading volume in the first half of this year. Compared with the China's stock market, China's futures market lags a little bit behind in terms of opening up itself to overseas investors. Back in 2002, China's stock market has allowed QFII, qualified foreign investors, to invest in the stock market. But it was not until 2018 that China's futures market introduced the first international product, crude oil futures, to overseas investors. But despite the fact that we're a little bit late in opening up ourselves to overseas investors, we have explored a unique way to open up. And in this regard, we believe that SHFE and INE can be a typical example of how China's futures market opened up. Just now I mentioned that in 2018, we launched the first international product, crude oil futures. This is also the first one in China's futures market that are open to overseas investors. And after that, we launched another 5 international products, including TSR20 rubber, low sulfur fuel oil futures, bonded copper futures, crude oil options, and the newly listed freight index Europe service futures on INE. And apart from those international products, we've also expanded the access channels for overseas investors. Last year, SHFE and INE opened 16 products to QFII, qualified foreign investors, further expanding the scope of products that are open to overseas investors. Briefly speaking, these are the major channels for overseas investors to trade Chinese futures market. The first one is to set up a wholly foreign-owned enterprise, WFI, in China. In this way, because WFI is a domestic client, so you can trade all the products listed on China's futures market. The second way, we often call it specified domestic products or international product channel. In this way, currently there are 24 products opened, and overseas investors can open account through an overseas broker or a Chinese broker to open account and trade these products. And the third channel is the QFII channel. In this way, overseas investors need to obtain the QFII license first, and then find a Chinese broker to open account and trade the 46 products that are open to them. And this slide further clarifies the different access channels for WFI, QFII, and specified domestic products. Let's look at the first side at first. As we can see, because WFI are domestic clients, so they have to open account through Chinese futures fund members to trade on INE or SHFE. And similarly, a QFII also need to open account through a Chinese futures firm and trade on INE or SHFE. But looking at the right side, for overseas clients, if they want to trade the international products, they can open account either through a Chinese futures member, Chinese broker, or through an overseas intermediary, we call them OI, and then they can also submit the orders to a Chinese broker or an OSBP to trade INE. So the account opening institutions are more verified in this method. This slide further compares the QFII channel with the specified product channel. In terms of participants, participants under the QFII channel are overseas entities with QFII or RQFII qualification, but participants under the specified product channel are broader in scope, not only including overseas individuals, but also general and special corporate clients. And in terms of qualification, participants under the QFII channel need to first obtain a license, QFII license from the CSRC, but under the specified product channel, there's no need to do that. And just now I also mentioned the account opening institutions. For QFIIs, they must open account through Chinese futures firms, but for clients under the specified product channel, they can either find Chinese futures firms or overseas brokers to open account for them. And in terms of margin currency, QFII clients can only use RMB as margin, whereas under the specified product channel, in addition to RMB, US dollars can also be used as margin. But in terms of investment products, the product scope under the QFII channel is broader. For us, we've opened 16 products to QFII currently, but under the specified product channel, only 6 products listed on INE are open to overseas investors. And lastly, in terms of physical delivery, currently QFII clients are not allowed to take part in physical delivery, but under the specified product channel, only those who cannot make delivery or accept the invoices required by the exchange cannot participate. And actually, there have been a lot of domestic and overseas industrial clients who are already taking part in physical delivery of our products, such as crude oil, low sulfur fuel oil, etc. And here gives us a general picture of QFII's participation in China's futures market, focusing on the number of newly approved QFII per quarter and the top sources of investment of these QFII clients. According to the list of qualified foreign investors released by the CSRC, by the end of September 2023 this year, there are 789 qualified foreign investors from 44 countries and regions. Most of them are from Hong Kong, China, Singapore, and the United States. In November 2020, the regulators consolidated the previous rules for QFII and RQFII, consolidated them into one new QFII rule. And after the new QFII rule was released, we've seen a large number of new applicants being approved by the regulator. The reason why there has been an emerging number of new applicants after the new rule is that the new rule set forth expanded the investment scope for QFII, adding commodity futures and options and stock index options into the investment scope of QFII. So more and more market participants found it's a business opportunity to trade on the Chinese market. And from the analysis of those newly applicants after November 2020, we've seen that most of them are still from Hong Kong, Singapore, and the United States. Traditionally, we know that most QFIIs are financial institutions such as banks, investment firms, funds, asset management firms, security firms, etc. But starting from late last year, we've seen new applicants with industrial background obtaining QFII qualification from the CSRC. Here are the products on SHFE and INE that are open to QFII. Altogether, there are 16 of them, including precious metals like gold and silver, non-ferrous metals like copper, aluminum, and zinc, and the ferrous metals like steel rebar and hot rolled coil, and the 5 international products on INE that are already open to overseas investors, crude oil, etc. For more details on these products, you can go to our official website for contract specifications or more information on the trading, clearing, and delivery of these products. Most of the products listed here are pretty liquid, pretty active in their daily operation. And you can also find the overseas counterpart contracts on the international markets, which means that market participants can also find enough room for cross-market arbitrage between our product and similar products overseas. In recent years, we've seen a growing market in our international business. From this slide below, you can see that almost all INE products have witnessed increasing average daily trading volume since their listing. And we've also seen that there has been a significant increase of trading volume by QFII clients from the second quarter this year, both on SHFE and INE. And most traded products or contracts are metal contracts. In addition, we've seen increasing participation of overseas clients and institutional clients. We had a global network of intermediaries, brokers. We have 150 domestic futures firm members in Chinese mainland, and overseas we have 79 overseas intermediaries and 2 overseas special participants, widely distributed in 12 countries and regions. The organizer of this event today, Aarna, we know that Aarna is the only one overseas intermediary from the UAE, and one of the supporting agencies here, Nanhua and Nanhua UK Financial. Nanhua UK Financial is also one of the overseas intermediaries registered with INE. Overseas clients can open account through these overseas brokers to participate on our market. Apart from opening up at the product level, we're also introducing supportive rules for the opening up of our market. For example, in terms of trading, in October 2020, INE launched trade as settlement task orders on crude oil futures. And in 2020, this year, we further optimized the task orders by expanding the price range and extending the end of daytime trading hours for task orders. Also, we've released market price on Shanghai crude and monthly average settlement prices on a lot of products such as crude oil futures, low sulfur fuel oil futures, and TSR20 rubber futures. In terms of clearing, the exchange have also released a lot of rules and measures to facilitate the trading of clients and reduce transaction costs. For example, in October 2021, Chinese government bonds could be used as margin collateral for international products. And this year, 2 foreign banks, DBS China and Citibank China, were approved to be the designated depository bank to conduct futures margin depository business for QFE and RQFE that it provides custodian service. And in August this year, both SHFE and INE introduced differentiated margin rates, reducing the margin rates for hedging by 1 percentage point. We're also preparing for other measures to further reduce the transaction costs for different market participants. And in terms of delivery, quite a lot of our deliverable brand come from overseas. For example, some of our rubber brands come from Thailand, Indonesia, and Malaysia. And most of the deliverable crude streams of Shanghai crude oil futures is from the Middle East, such as Basra, Upper Zakum, and Oman. And we're also exploring overseas take delivery on some of the products, such as low sulfur fuel oil. Currently, the overseas investors of our market come from 30 countries and regions in 6 continents. In terms of client types, it's pretty diversified, not only including industrial clients, trading houses, financial institutions, and also with retail investors. Most of these overseas investors open account and trade on our market through overseas intermediaries. And in a lot of our products, we've seen a pretty healthy market participant structure. Take Shanghai crude oil futures, for example. In 2022, institutional investors on this product accounts for about 50% of average daily trading volume and over 70% of average daily open interest. And overseas investors on this product account for about 25% of average daily trading volume and over 30% of average daily trading volume. This year's figure is almost pretty much the same as that of last year. And compared with the purely domestic product, these proportions are way much higher than the purely domestic contracts. As we develop our contracts, a lot of our contracts are gradually accepted by industrial clients, and some corporate clients even use our INE prices as the benchmark price in the quotation and settlement of cross-border trades. As we can see from these examples, bond and copper futures and TSR20 futures prices have been used by some industrial clients in the domestic and global physical trades. And through all these years of development and with the support of various parties or members, overseas intermediaries, and overseas special brokerage participants, our exchange have gained pretty wide global recognition. And actually, before we launched international products, INE and SHFE have also did a lot of work in overseas registration and recognition. For example, INE completed its overseas registration in Hong Kong and Singapore, which greatly facilitated the participation of overseas investors from these 2 regions. And also, SHFE and INE are both in ESMA's list of third country venues in the contest of opinion on post-trade transparency with a positive assessment. We're also active participating in global futures industry, and we're members of WFE and FIA. In addition, both SHFE and INE have established a standardized and complete CCP clearing mechanism according to PFMI requirements of IOSCO, and both of us are QCCPs approved by China Securities Regulatory Commission. In addition, we've won a pretty lot of awards. For example, this year, SHFE and INE have won 3 awards from Energy Risk Asia. SHFE and INE was awarded Commodity Exchange of the Year, and our product, Steel Bar and Silver Options, was awarded Innovation of the Year. And SHFE's OTC platform, which is mainly the major business of it is the trading of electronic standard warrants, won the award of OTC Trading Platform of the Year. Next, as we move forward, we will continue to launch more international products such as LNG futures and options, providing more risk management tools for both domestic and overseas investors. In addition, we will develop more new products in different sectors and release flexible trading tools and reference prices on more products such as TAS, monthly average settlement prices, etc. And in terms of overseas marketing, this year we began to have more and more meetings with overseas entities. And from these discussions and communications, we found that people's understanding towards Chinese futures market is still need to be improved. And if we have the opportunity, we think that next year we'll continue to do more marketing activities so that people in overseas markets can have a better understanding of our market. Currently, we have diversified forms of overseas marketing activities, and next year we will do more in more countries and regions. And also, we will continue to provide daily support to our members and overseas brokers. So this is a brief introduction of my presentation. And to learn more, you can also visit the official website of SHFE and INE, or if you still have further questions, you can also contact us. And on the bottom right of this slide, you can see a QR code. If you want to join INE's mailing list, you can also scan the QR code. And by this way, you can receive a monthly update from the INE regarding the latest update of our products and the latest news and circulars on our website. Okay, that's all for today. Thank you.
The metals there, in the metal business for 15 years. I'm going to keep this really brief because we were running over, but just want to introduce our company and what we do, and we'll pass on tomorrow with the most important bit that we need to do. So just introducing Nanhua. We are Nanhua Financial and we are based in London. We have offices in Chicago, Hong Kong, Singapore, Shanghai and Beijing. Here is a list of some of the exchanges that we are currently on. And I just want to talk quickly about the organisational structure that we have. So we are a subsidiary of Nanhua Futures in mainland China. We then have HG&H, which are covering Hong Kong and Singapore, which then have intermediaries, which includes ourselves, which covers USA and London. There's a list of some of the exchanges that we're on in the UK, USA, Singapore and Hong Kong. Obviously, we have access to all China mainland markets as well. I'm going to keep it really brief like that because what Mara has to say now is much more important than what I've got to say. So I will pass it on to Mara straight away. Let's get going. Well, I don't increase tomorrow. Oh, okay.
Thanks everyone for speaking with us for this long, and there's most exciting subjects coming up as well. I'm the CEO of Nanhua Financial in UK, came all over from London to see everyone. What we're trying to say is that we are a UK registered brokerage company regulated by FCA, and our target is to become a one-stop shop for most of the derivatives in globally. So our target is, or our slogan is global clearing. We clear at the moment. We clear LME. Very soon, in about 2 months' time, will be ICE member. Through us, you can clear CME contracts, Singapore Exchange, Hong Kong Exchange contract with us through our sister companies in all those major cities. And as well as being those exchanges, one of the most interesting subjects today is access to China. So why access to China? We just had the very good presentation from Shanghai Futures Exchange, and how do we access China? This is a mystery for a lot of people. Even if you have interest, you want to know what to do, but it's like seems to be 100 million doors open and actually shut, you don't know what to do. So Mara's going to have a little brief introduction of what the products are there available, different forms, and depending on your choice and your interest of trading and how much you want to get involved in trading the Chinese contract, then we'll make the right choice, help you to make the right choice for yourself. If you want to get into very complicated matters, setting up your own booth in a country, you can do that. If you want it to be simple, adding an exchange as if you're just adding CME to an LB, and we can do that as well. So there are different ways of involvement of access to China. And so Mara's going to have a little introduction for everyone. Whilst you're sitting on the chair, you can see that apart from the little leaflet, we have our little gifts for everyone. It's a pen, copper pen, because copper is our most product. Everything we talk about is around. So it's a little present from ourselves. It's made by a very famous, top famous copper art designer in China. So take it home for yourself. Take a couple more if you want with your colleagues. Little gifts from ourselves. Now I'm going to hand it over to my colleague from Shanghai, Mara, to do some more explanation on the options and choices you can have to access the Chinese products. Thank you.
Thank you, Long. Thank you for having me today here, and thanks for everyone coming today. I'm Mara Wong from International Department of Nanhua Futures, and I'm based in Shanghai. Today, I'll bring a brief introduction of how to access Chinese market. Before you access Chinese market, you always ask why? Why China? So here is a brief reason, like why you choose Chinese market. We go back to check the history of the trading volume at first. Actually, the Chinese futures market is super young. We only have 30 years of the history, but from this table, you can easily see how fast we are growing in this market. And in 2022, actually, we have the trading volume already 6.7 billion. Sorry, allow me the big number here because it's from our traditional Chinese research. So the unit actually is in 10,000 lots. So that's why the big number on the left is like that. But actually, you check on the last year, on 2022, our trading volume is 6.7 billion lots last year. And this year, from the January to September, our number is already reached 6.5 billion lots. So almost the same like the whole year last year. Starting from exchange, already shared the detail of who are the top 10 in the global markets and who are the products. And here I just give the general numbers. Actually, in the top 20 of the global exchange, Chinese agricultural products already sits 16, and 14 of the Chinese metals are already in the top 20 list in the, sorry, I need to change. Oh, can I talk just like that? Yeah, okay. Yeah, so 40 metals is already in the top 20 in the global market, and 5 of the energy products, and 3 in the precious metal is top 20 in the global products. So you already found the fast speed of the growth and some interesting products, and now you worried about how regulated of the Chinese market. So here we are showing who is supervising us. At first, we have the CSRC, our big boss in China. We always looking after us. Then we have exchange like IME and SHFE. Then we have the China Futures Association, the most important you always care about how you deposit your margin and is it safe. So actually we don't care keep your money. We have the China Futures Market Monitoring Center. The main job of them is always supervising the safety of the margin. So your money is always safe in China. Even one Chinese broker, they stop their business, your money is still okay. Then we also published some laws about Chinese futures. Everything is super in detailed. And if one day you come to China, we will show you everything in the English version, what you need to learn for our super regulated future trading rules here. But the fundamental one is the first we published like recently, which already like become very popular in the foreign investors to learn Chinese market here. These numbers already published in the 2022, so it's still in the longest time. Already more than half of the percentage, they have the interest in the Chinese market and plan to enter, and around 17 of them are already in Chinese market. I think now it's 1 year later, majority of them already take their actions. So tomorrow is ours. Let's take a action today. We already know why we choose Chinese market, then what is in China in detail. So here is our all products, which is 128 in the market yet. And you can see here is QFI here and the international contracts here. And I put Nanhua logo is you have the cross-market arbitrage opportunities with the main products in other markets. In this page is mainly about Chinese commodities futures, but here we're talking about Chinese financial futures. As we know, at this moment, they only can for hedging, and as well the interest rate futures and options still not open for the foreigners. But there is inside information because a lot of meetings are already organized by the exchanges with brokers talking about more and more the interest rates futures, how they impact the society. So we believe in the near future, the important interest rates futures will also go to the market for our foreign investors. So here is also people always ask like, what is top 10, what we can trade? So I put everything like in terms of the contract volume and the turnover and also positions. This is a top 10 for the Chinese market. So how to access Chinese market? We make it very easy. So you have main 3 ways. Except for OTC, we don't talk about it today. You have 3 main ways. One is set up a WFI immediately inside of China. Then your fund gonna raising in China. Then you can trade like 128 products. And another way is you apply for the QFI license. Then you put your fund inside of China. Then you can deposit it. You can take it out. Or you can trade the 24 international contracts through the overseas intermediary like Aarna, like our UK branch. They will take care of your money out of China, but you have the access in the Chinese market. So here is the details. Who are interested of the different ways? First one is QFI, always financial institutions and the trading firms. And for the international contracts, they are industrial clients because the international contracts also can do the delivery, as a commodities delivery. And also tax-free. And for the QFI, you can benefit of all the scope of the futures and options, but you need to pay 25% of the tax before you leave China. So you can choose which one you favor with. So we talk about QFI. What is QFI? QFI refers to the foreign institutional investors. Before we have QFII and RQFII. Now we put them together because US dollar or renminbi we all can invest in China now. So here is a QFII investment scope. You not only can trade the Chinese futures and options, you also can go to the bond and also stock market. Now you know the access, then you may care about how long time you will take, no matter you come from QFII or from the international contract. If you immediately work with a Chinese broker as an OI or like a QFII investor, the maximum you will take is 2 months because the detailed process we will offer you is like this. Here is trading hours. Majority of the products you can trade through the from the 9 a.m. and we take a small break, then finish at 11:30. Then we start at 1:30 and finish at 3 p.m. Then we also offer the night hours. So we are super fair because like for all the Chinese clients or foreign clients, you share the same like trading hours and all the trading rules actually. Don't be scared of the risk management here, like because we will give you like friendly all the margin calls if you need it, like to know it on time. And before you trade, we will give you all the English version education, how the special rules here. So here is a bit pinpoint, but here we have the switch sugar here, which is USD and the treasury bonds margin. So if you trade from the international products, we offer you to deposit the margin immediately, use your USD, then you have 5% of the haircut. Then you also can trade through QFII immediately to the Chinese market. You use your cash to open the futures position at first. At the meantime, you buy the treasury bonds. When you finish these two actions, then you use your treasury bonds position as a margin deposit with your commodities futures position margin. Then you can just withdraw your cash from the future side. So what we can support you? One is we have the Nanhua cloud services. We can offer you massive big data from the Chinese market, stock, bonds, public funds, private funds, because QFII, you also can invest the public funds and the private funds, which should be in the QFII investment scope. Sometimes the clients, they don't want to trade by themselves. So they come to look for some good trading strategies, then they can invest in that fund immediately. So we offer all the rankings of what is good funds in Chinese market, then you can invest immediately. And there is two regarding to the futures market, which is before you enter Chinese market, you might need some data to check your trading strategy is good or not. So let us know. We can offer you 3 to 5 years level 5 tick historical data for you to check your relative products or trading strategies match Chinese market or not. As we mentioned for the funds, so we also have the asset management services. All the funds we introduce to our QFII client or foreign clients, we always check it by ourselves. So at the beginning, we found the good investment advisor, then we will use our Nanhua Pro funds to test the stability. When we have the historical data, good performance, then we will put it in the list to our clients. Here is the IT solution. We have all the main IT platform, for example, TT, CQG, and Bloomberg. It's very famous globally. And as well, we have eSigning and the CTP from the Chinese market. So if you already trade with TT, CQG, etc., we offer you the API docking, just connect with the CTP. It's super easy to get the market data and also the trading access. Also, we offer all the co-location services. If you are high-frequency trading firms, then let us know what kind of level of the machine you need, and we will check we have it or not. Then we will help you to fund it. Nanhua Commodities Index is very famous in the Chinese commodities market because we already have more than 19 years historical data. We are the oldest index in the Chinese market, so it's a benchmark. We published in the wind, and all the Chinese and the foreign investors, they will use us as a benchmark to check their performance is good or not. And as well, last year, we already went to the market, which means the Chinese clients, they already can trade it as our OTC product. And we are prepared to publish a private fund, trade the Nanhua Commodities Index within the QFII investment scope, which means if you have the diversity strategy for global and you just want to invest a bit of the Chinese commodities market, then you can just buy the Nanhua Commodity Index product as part of your fund. Okay, so Invent is a small introduction about us. We are the first A-share listed futures in Chinese market, and we have the largest number of the sub companies out of China. We are in London, Chicago, Singapore, and Hong Kong. We have securities company, futures company, and asset management company out of China, and we have capital company, public fund company, and private fund company inside of China, and we have 41 branches around China. So here is just a bit global clearing membership qualification pictures. I'm from the headquarters here, Nanhua Futures, and we have all the access to the Chinese exchange, all the clearing memberships. Then we fully own the HG&H International Financial, which is in the Hong Kong market, is our financial like totally owned sub company in Hong Kong. Then we have Nanhua UK branch as a sub-company of the Hong Kong Financial Group, which have the INE and also the overseas intermediary in the Chinese market, and the ICE Europe is coming soon as well. And this is the rest of our sub-company out of China. So usually if the client interested of the Chinese market or Asian market, then if you want to do the stock, just open an account in our Hong Kong securities company, and if you want to do the futures, pick any sub company who has the global clearing access as well. Like Aarna is the only one in Middle East who got the overseas intermediary license and as well the QFII license. So just pick any of them and welcome to let us know what we can help you more. Thank you so much.